Imagine closing a meaningful round of funding. The round is finalized. The announcement is shared, and your company enters a new phase of growth. The valuation reflects stronger belief in your direction, and the additional capital expands what feels possible. There is a sense of progress and momentum. At the same time, something quieter begins to change. When capital enters a company, responsibility expands with it. Even when the terms feel supportive and the board remains aligned, an exchange has taken place. Capital has been provided, and with that capital comes a shared expectation of oversight. Over the next few months, you begin to notice small adjustments. Board meetings become more structured. Updates become more detailed. Questions reach deeper into assumptions that previously moved quickly. Hiring plans receive closer review. Spending decisions are discussed with more care. None of this feels aggressive. It feels logical. Investors are responsible for the capital they commit. They are accountable to their own stakeholders. When risk increases, attention increases. Still, something has shifted. So you ask yourself a clear question. What decisions now require broader alignment, even if my ownership remains the same? Control is not only about percentage ownership. It is about who participates in major decisions and when alignment is required. Who approves large acquisitions? Who signs off on senior executive hires? At what level of spending does the board expect advanced discussion? When performance changes, who helps determine the next move? Each round of funding adjusts these boundaries slightly. In early stages, decisions move quickly and rely heavily on instinct. As institutional capital enters, decisions require greater clarity and shared understanding. The shift can feel gradual, yet it is real. Rather than resisting this change, you decide to define it clearly. You take time to map decision responsibilities. You identify which decisions remain fully within executive authority and which require board input. You clarify the financial and strategic thresholds that trigger broader discussion. By doing this early, you prevent confusion later. This changes your experience of oversight. You also acknowledge the emotional layer. Funding often feels like recognition of your vision. Increased review can feel like reduced independence. The maturity of leadership shows in how this tension is handled. You begin treating governance as a design choice rather than a restriction. In board discussions, you present trade-offs clearly. You describe both opportunity and risk in the same sentence. You explain how you will adjust if performance shifts. You might say our current spending remains within the range we agreed upon. If growth slows beyond this point, we will reduce hiring and protect runway. That language communicates discipline and shared accountability. Over time, you realize that capital and control are partners. Capital provides fuel for expansion. Clear decision structures protect stability. When expectations remain unspoken, tension builds quietly. When they are discussed openly, trust grows. So you bring it into the open. As we continue to grow, which decisions would you like visibility into earlier? Where should we align before acting? This question replaces assumption with clarity. Strong partnerships form when both sides understand the exchange. Investors provide resources with responsibility, leaders guide the company with transparency. The balance between these roles shapes long-term trajectory. You begin measuring success not only by growth metrics, but also by the health of decision-making. Our responsibilities clear, our expectations understood. Does oversight strengthen clarity rather than slow progress? The unspoken contract becomes explicit through steady communication and mutual respect. You move forward grounded and deliberate, stewarding capital responsibly, defining decision authority clearly, and leading with maturity that balances growth with disciplined governance.